Studies have shown that a whopping 90% of your future investment returns depend on the asset allocation you choose. For example, a 60% stock, 40% bond portfolio versus a 70% stock, 30% bond portfolio. But another critical factor is how often you rebalance your portfolio. For example, would it be better to follow a calendar-based approach where you rebalance your portfolio either annually or monthly or maybe even quarterly? Or would it be better to follow an absolute rebalancing strategy? So, for example, if stocks were to get, say, 5% over or underweight your portfolio, i.e. a 60-40 portfolio, you would rebalance whenever the portfolio reaches 65% or 60. And if this is the best way to do it, should you wait until the portfolio gets 5% off, 10% off, or maybe even 15% off? Finally, would it be better to follow a relative rebalancing approach? In this case, you would look at the percentage of the overall allocation. So for example, a 60% stock portfolio at a 20% relative allocation. So in this case, you would rebalance the stock allocation whenever it got off by plus or minus 12%. In this video, we're going to look at the historical evidence for each one of these rebalance techniques and different weightings for each. I'll first take a look at the academic research behind these different options. Then I'll look at my own study, which goes from 1972 all the way through September 2024, which is when I'm recording this video, to see which of these rebalancing techniques work best over that 50-year time horizon. And at the end of the video, I'll summarize all of the evidence-based reasons for why you should pick two specific asset allocation rebalancing techniques. And then I'll share how you can get even more content on asset allocation specifically if you're looking to determine what the best is for you. First of all, I wanted to announce that as of this video and hopefully every other video that I ever make, I'm no longer going to be running any YouTube ads. Instead, I'm going to be relying on you and your support. So if you like this video or any of my other content, you're also going to most likely love my premium content. For real-time updates on the stocks that I'm buying in my coffee can portfolio, you can join Patreon, what I call the Coffee Can Investing Club, where I'll post whenever I buy new stocks in my coffee can portfolio and the performance updates for that. You can also check out my book on Amazon. You can get it in either Kindle or paperback edition. The book is about dividend growth investing and has, at this point, over 1,200 reviews and has sold more than 10,000 copies. And then finally, you can get access to my premium courses. Right now I have two. Both of them are 4 hours long with over 50 videos each. The first is a more advanced video for those of you who want to select your own stocks. This is on how to value stocks like investment legends such as Warren Buffett, Peter Lynch, Benjamin Graham. And then I also have a more intermediate/beginner course on how you can reach financial freedom, which means you can generate passive income to entirely cover your living expenses and retire at any age. This course goes in depth into asset allocation, which we're going to talk about in this video. Using the link in the description below, you can actually see the entire asset allocation section of this particular course. So I'll put a link in the description down below if you want to watch all 9 videos on asset allocation that are in this particular course. For the first 100 students in each course, I'm offering a significant discount. So check out the link in the description down below if you're interested in either one of these. Now back to the video. A study from Vanguard by Giaconelli, Kinnery, and Zelber-Ring basically found no material differences in outcomes for rebalancing frequencies. So they looked at monthly rebalancing to annual rebalancing measured on a rolling basis. And when they looked at a 60-40 portfolio going back to 1926, they found that the rebalancing annually generated the exact same long-term returns as rebalancing quarterly, but generated significantly less rebalancing events, which reduced turnover-related costs and taxes. The annual rebalance also had less volatility. So according to Vanguard, it is actually better both tax-wise and cost-wise, as well as requiring less effort to just rebalance annually instead of quarterly or monthly. A 2007 study in the Journal of Financial Planning called Opportunistic Rebalancing looked at different 5-year periods from 1992 to 2004. The researcher Daryani found that the optimal rebalancing threshold was actually using the relative rebalancing method of 20% of the original weighting. So, as we talked about in our first example, if the stock allocation were at 60% and you used a relative rebalancing band of 20%, that would result in a 12% plus or minus target before you would rebalance the portfolio. So that would be either 72% or 48%. A smaller relative band would reduce this amount. So for example, a 5% relative rebalance band would be 60% multiplied by 5% or 3% of the overall portfolio. So for example, 57% or 63% stock weighting would be when you triggered a rebalance. But he found that this 20% was the optimal amount. A study by T. Rowe Price looking at data from 1998 through 2023 found mixed results depending on whether your starting allocation to stocks was 30%, 60%, or 90%. Before the classic 60-40 equity portfolio, they also found that relative bands were superior to both no rebalance and fixed bands, but instead of 20%, they found that 25% was actually the superior rebalancing method, as shown here by these green bands. They also demonstrated that the 25% relative bands was slightly better than 20%, even at the lower equity allocation of 30%. So you can see 25 was better than 20 across the board, and also at the higher equity allocation of 90%. But they did find slight improvements using fixed bands at the 90% equity allocation and the 30% equity allocation. T. Rowe Price found that using the wider bands was better for taxable accounts because they resulted in fewer rebalancing triggers per year. But what if we look at data going back even further? I did my own study going back all the way to 1972 and all the way forward to 2024. So I used portfolio visualizer data to go back super far, and I used an asset allocation between US total stock market index, which would include every single stock in the United States, and I also used 10-year US Treasury bonds for my fixed income allocation. I also tried 2 different scenarios. So in scenario 1, I assumed that you were an accumulator. So in this illustration, we did starting with a $1,000 portfolio balance in 1972, and then adding $1,000 each year in every year after that, adjusting this upward with inflation. I also looked at a decumulator. So in this case, we assumed that the starting portfolio value was $100,000, and the person was following the 4% rule, taking out $4,000 per year and increasing that each and every year with inflation. In both of these scenarios, I looked at the 3 different rebalancing techniques that we've talked about so far. The first being the calendar base, the second being the absolute base, and then the third being the relative base. I also looked at the coffee can style, which would be no rebalancing. So which one of these rebalancing techniques came out on top? Well, it actually depends on whether you are accumulating or decumulating. While you may not think that matters, it turned out that that definitely mattered in the study that I did. Let's start with the accumulator. So this would be someone like me who is actively adding money each and every year to their retirement portfolios. What would be the optimal rebalancing technique for me and someone else that's accumulating wealth over time? And I sorted these by the worst performing strategy sorted by ending value. So the worst strategy for the accumulator was to rebalance the portfolio monthly. This was interesting because this one would also require the most work and it would come with the highest transaction cost. The second worst was rebalancing twice a year or semi-annually. That resulted in a portfolio of $352,000. Next, we had 2 relative rebalancing strategies of 5% and 10%. Rebalancing annually and quarterly came in at basically the exact same amount. Then we got to an absolute rebalancing of 5%, followed by the relative 15 and relative 20. Rebalancing an absolute plus or minus 10% came in 4th. And then the top 3 was the relative 25%, which matched the T. Rowe Price study, the rebalance absolute of 15%, And then the number one best performing strategy was not rebalancing at all. This came in substantially higher at 452,780. However, keep in mind that this also resulted in a higher maximum drawdown and a worse risk-adjusted ratio. So if you're someone who's sensitive to downside risk, it would be better for you to rebalance the portfolio. Just try to rebalance it as little as possible by using these wider bands. After these first results, I thought, great, the coffee can methodology seems to work for both stocks and asset allocation, at least for accumulators. But what about someone who is decumulating, i.e. taking money out of their portfolio for retirement, actively spending money rather than adding it? In this case, I found very different results. If we have a starting value in January 1972 of $100,000, the no rebalancing strategy, starting at 60-40 and then just letting the portfolio drift over time, actually ran out of money by August 2024. Maximum drawdown here was top to bottom minus 100%, and the risk-adjusted ratio was the worst of all these portfolios. And then exactly the opposite as before, in the second worst place rather than second best place, we have the rebalance plus or minus 15%. This also resulted in a portfolio falling to a 0% ending value. Next, we had the relative 15% and relative 20% strategies. These resulted in having more money at the end than you had at the beginning, so they did survive this entire simulation. However, the decumulators seem to favor more of the frequent rebalancing strategies. So 3 of the top 5 performing strategies were rebalancing semi-annually, quarterly, and once again we see annually here as the best calendar-based option. But interestingly enough, we had the relative 25%, just like the T. Rowe study suggested, that came out as the overall best performing strategy, but tied with the rebalancing 10% absolute strategy. However, it's important to note that this is heavily dependent on the specific market environment that happened. So, for example, you can see the difference between the relative 25% rebalancing strategy and the relative 20% rebalancing strategy was significant, even though the difference between these strategies was only 5%. In other words, there's no rebalancing panacea. It's always going to depend on the market environment that you find, but we can take some clues from history on these studies that we've looked at so far in my own study that the best strategy for wealth accumulators, those adding money to their portfolio, is most likely going to be a coffee can type strategy. But the biggest reason for this is not necessarily that the coffee can is anything special regarding asset allocation. It's just that this generally resulted in a higher allocation to stock. So a higher stock allocation is generally going to result in higher long-term returns. So for someone that's adding money to their portfolio and has a long time horizon, a higher stock allocation is going to be the best. However, for a decumulator, this is someone who is taking money out of their portfolio. Now it becomes extremely important to rebalance your portfolio on a regular basis. The studies were mixed on this, ranging from either an annual rebalancing schedule to a wider relative 25% band as being optimal. Considering taxes, however, I would think that the wider band relative 25 would be optimal. If you're looking at only IRA accounts, then the annual rebalancing strategy could be ideal. And then finally, for those of you just looking to keep it simple, stupid, the best calendar-based option seemed to be using annual. That was overall conclusive from the T. Rowe study to the Vanguard study to my study as well. The easiest way to rebalance your portfolio is probably just going to be check it once per year and rebalance it back to your starting allocation. However, if you want to try to optimize even further and don't mind doing a little extra math, using the relative 25% strategy could be optimal. For more information on how to appropriately allocate your account between stocks and bonds, check out my course, The Financial Freedom Formula. formula. You can access the entire module about asset allocation for free. I'll put a link in the description below, linking to the very first video. You can watch each one of those in sequence. If you're interested in buying the entire course, for a limited time, I have it available for $47. That is for the first 100 students that sign up. If you're looking for more advanced stock selection valuation topic, check out the How to Value Stocks course. And for updates on my coffee can portfolio, you can check that out over on Patreon. I just posted a link to a video that talked about this very topic. And a couple weeks ago, I posted my buys for the coffee can portfolio at the end of August 2024. Thanks to all of you who are currently supporting my work and helping keep this channel ad-free. Thanks for watching, and I will see you in the next video.